If you're between 60 and 65, there are 4 financial moves that are available to you right now that will never be available again. Miss one of them, and you could be paying a Medicare penalty for the rest of your life. Point 1, the super catch-up contribution. The first opportunity involves your retirement accounts, and it's one that most people in this age range are leaving on the table completely. Here's some background. When you turn 50, the IRS allows you to contribute more to your retirement accounts than the standard limit. It's called a catch-up contribution, and it applies to both your 401k and your IRA. For your 401k, the standard contribution limit in 2026 is $24,500. And once you turn 50, you can add an additional $8,000 on top of that, bringing your total to $32,500. For your IRA, the standard contribution limit is $7,500 in 2026. The catch-up is another $1,100, bringing your total to $8,600. That's the baseline that most people know about, if they know about it at all. But here's what nobody talks about. The Secure Act 2.0 added a second layer on top of that for your 401k. If you're between ages 60 and 63, you're eligible for what's called a super catch-up contribution, an additional $11,250 on top of the standard catch-up. In 2026, that means someone in this age range could potentially put in $35,750 in a single year. And here's the cliff. The day you turn 64, that enhanced contribution disappears. You drop back to the standard catch-up amount, and you never get those years back. It's strictly use it or lose it. The IRA catch-up remains at $1,100. The super catch-up applies to workplace retirement accounts like 401ks. But if a 401k isn't available to you, maxing out your IRA catch-up every year during this window still matters. Now, before you do anything else, call your HR department or your plan administrator this week, not next month, this week. Confirm 3 things. Does your plan offer the super catch-up? Is it set up on payroll so that contributions are actually being directed correctly? And if your income exceeds $150,000, does your plan offer a Roth option for your catch-up contribution? Not every plan is caught up with this provision yet, and if yours hasn't, that's a conversation worth having sooner rather than later. One more thought before we move on, and this is important to anyone who already has a significant pre-tax balance in their retirement accounts. More money into a traditional 401k isn't always the right move. If you're already looking at a future RMD problem, meaning you expect RMDs in your 70s to push you into a higher tax bracket than you are today, then blindly maxing out the pre-tax side of your 401k can actually make that problem worse. The super catch-up doesn't have to go in pre-tax. If your plan allows for Roth catch-up contributions, you may have the ability to direct these late-stage contributions to the Roth side instead. It costs you a tax break today, but it may save you significantly more in forced taxable income later. This is exactly the kind of decision that depends on your specific situation, which is why a conversation with a financial advisor before you make any moves here is worth your time. And there's one more wrinkle worth clarifying. If your wages from that employer were over $150,000 last year, a threshold that's indexed over time, the law now requires that any catch-up contributions, including the super catch-up, must go in as Roth, not pre-tax. For higher earners, late-stage contributions can be Roth-only starting in 2026 if your plan allows for Roth contributions. That's not a choice, it's the rule. And if your plan doesn't offer a Roth option at all and you're over that wage limit, you'll not be able to make catch-up contributions under the current plan design until it's updated. One more reason why that call to your HR department or plan administrator isn't optional. Point 2, Medicare enrollment. Age 65 is when Medicare begins for most people, and it comes with what's called an initial enrollment period, a 7-month window centered around your 65th birthday, 3 months before, the month of, and 3 months after. Miss that window, and Medicare charges a 10% penalty on your Part B premiums for every 12 months you were supposed to be enrolled but weren't. And here's what people don't fully appreciate. That penalty doesn't go away. It follows you for life. The main exception is if you or your spouse are still working for an employer with 20 or more employees and you're still receiving health insurance through that plan. When that employment ends, you have an 8-month window to enroll. Miss that and the penalties apply. A quick word on COBRA. If you retire and go on to COBRA to maintain your coverage, that does not qualify as creditable insurance. Same goes for retiree health benefits from a former employer. Neither one protects you from the penalties. Age 65 is a hard deadline, Put it on your calendar now. Point 3, the HSA contribution stop. Health savings accounts are one of the best tools for retirement planning, and I'd argue one of the most underused. Here's why they're so powerful. First, the money goes in pre-tax, meaning every dollar you contribute reduces your taxable income now. Second, it grows tax-deferred inside the account. No taxes on capital gains or dividends or interest while it stays inside the account. And third, when you take it out for qualifying medical expenses, you pay no taxes on the growth or the original contribution. That's a triple tax advantage, and there's no other type of account in the tax code that gives you all three. For that reason, a lot of people, especially high earners, get in the habit of maxing out their HSA contribution every year and putting it on autopilot. But here's where autopilot can become a problem. When you enroll in Medicare, you can no longer contribute to your HSA. Most people know that part, but here's what most people don't know. Social Security often backdates your Medicare Part A coverage by up to 6 months before you enrolled. So if your Part A gets backdated, any contributions you made during that backdated period become excess contributions. And excess contributions carry a 6% penalty every single year until you pull them out. Let's make that concrete. Assume you and your employer contribute $5,400 to your HSA in the first 9 months of the year. You decide to retire in October and you apply for Medicare. If Social Security backdates your Part A to April, that means your HSA eligibility ended retroactively as of April 1st. So only the contributions from January through March are clearly allowed. Everything contributed from April through September is considered excess. The good news, if you catch it in time and you withdraw the excess contributions plus any earnings on them before your tax filing deadline, including extensions, you can generally avoid that penalty altogether. But that requires you to know that it happened in the first place. Most people don't. So here's exactly what to do. Contact your HSA administrator directly and tell them you're approaching Medicare eligibility and need to stop all HSA contributions, including employer contributions, at least 6 months before you intend to apply. Put that date on your calendar and confirm in writing the contributions have actually stopped. Don't assume it'll happen automatically. It won't. Point 4, IRMAA. The fourth opportunity is one that most people have never heard of until the day they open their first Medicare statement and see that their premium is significantly higher than they'd expected. That's usually the first time someone discovers what IRMAA is. I'd rather you learn about it today. IRMAA stands for Income Related Monthly Adjustment Amount. It's a surcharge added to your Medicare Part B and Part D premiums based on your income. And here's the part that catches people completely off guard. Medicare doesn't look at what you're earning right now. They use a 2-year lookback. When Medicare calculates your Medicare premiums at age 65, they're looking at your income from 2 years prior when you were 63. For 2026, the first IRMAA tier kicks in at $109,000 of modified adjusted gross income for a single filer and $218,000 for a married couple filing jointly. And here's what makes this particularly unforgiving. There's no phase-in. It's an on or off switch. $1 under the threshold and you owe nothing. $1 over the threshold and you owe the full surcharge for that entire year. Now here's why ages 63 and 64 are so important in this context. For many people, these are the cleanest income years they'll see heading into retirement. You may have already stopped working or cut back significantly. You're likely not collecting Social Security yet if you're waiting for a higher benefit. And required minimum distributions don't start until age 73 or 75, and that's years away. Your taxable income may be lower than it's been in decades. That makes this window genuinely valuable for Roth conversions. And a lot of people take advantage of that, which can be smart planning. But here's the trap. Let's say you're a single filer at 63 with $90,000 in modified adjusted gross income. You're $19,000 below the first IRMAA threshold. You decide to do a Roth conversion and convert $19,001. That one extra dollar just triggered an IRMAA surcharge on your Medicare premiums starting at age 65. And it lasts the entire year. That last dollar you converted might have cost you more in Medicare premiums than it would have ever saved you in future taxes. And it doesn't have to be a Roth conversion that pushes you over. Part-time consulting income? a pension, a large capital gain from selling a property or business? Any of these can move your modified adjusted gross income closer to that IRMAA cliff than you'd realize. Every dollar counts. So here's what you do. Pull out your most recent tax return and find your modified adjusted gross income. That's line 11 on your Form 1040, plus any tax-exempt interest. Compare it to the IRMAA thresholds for the year your Medicare premiums begin. If you're within striking distance of a cliff, be surgical about your Roth conversions. It's genuinely better to be $1 under than $1 over. And zoom out for a moment. Age 63 and 64 may be the last clean income years you'll see for the rest of your life. Once Social Security begins and RMDs kick in, your taxable income goes up and stays up. The window of opportunity to manage your income strategically before Medicare looks back at it is right now. Here's what I want you to take away from this video. These 4 opportunities are not 4 separate decisions. They're one decision about how you want to enter one of the most important financial stretches of your life. They're connected in ways that matter. A super catch-up contribution can lower your modified adjusted gross income, which gives you more room for Roth conversions without tripping an IRMAA cliff. A late Medicare enrollment to keep your HSA open could cost you a lifetime Medicare premium penalty. A Roth conversion that looks perfect on paper could push you over an IRMAA threshold and cost you more in Medicare surcharges than it ever saved you in taxes. Pull one lever without looking at the others, and you can undo the benefit entirely. The people who navigate this window well aren't necessarily the ones who know the most. They're the ones who treat it as one connected decision and give themselves enough time to make it thoughtfully. But here's the reality. This window has a hard edge. The super catch-up closes the day you turn 64. The HSA clock starts ticking 6 months before you apply for Medicare, and the IRMAA look-back is already capturing your income at 63. These deadlines don't move, and they don't make exceptions. If you're between age 60 and 65, the window of opportunity is open right now, but it won't stay open for long. This is the kind of retirement planning we do with pre-retirees every day. If you'd like to talk about where you stand on any of these 4 opportunities, reach out. We offer a no-cost, no-obligation consultation. I'll leave a link in the description below. And if you found this video helpful, I bet you'll find these videos of interest too.